All right. Well, thank you all for joining us again today for this brand new episode of Daloopa's data modeling webinars. In today's call, Thomas will walk us through and share some very interesting thoughts on how credit investors have been and can use Daloopa to leverage their investment opportunities. So with that, I think I'll hand it over to you, Thomas.
Thanks, Thomas. Hey, everyone. So one of the things that a lot of our customers ask us about is to explain how our data is relevant for credit investors. A lot of our customers today are high yield credit investors, and they primarily spend their time looking at high yield bonds, once in a while the equity of companies, and a lot of these companies we do cover at Daloopa today. So what is it that a lot of credit investors end up caring about? Like equity investors, they obviously care about the business, the trajectory of the business, the margins of the business, and so on. So anything from KPIs to financial metrics to operating metrics, like these are all the information that is widely used by credit investors. Where we see the difference between a lot of credit guys and equity guys is when it comes down to the understanding of the balance sheet, the cash flow statement, as well as the debt breakdown. So what we've noticed in a lot of our customers who are more equity focused is that they tend to spend more time in the operating segment of the company, right? They like to build different methods to drive top line, to drive costs, and so on. Whereas what we see a lot of credit guys like to do is they spend more time in the balance sheet, in the cash flow statements, in the adjustments, right? Because what you're fundamentally trying to figure out is, I need to get a good understanding of what true free cash flow is. So I need to have a good understanding of what actual EBITDA is. How do I get from EBITDA to free cash flow? And what are all the adjustments in there? How many of these adjustments are recurring? How many of these are true one time? And then ultimately, what the debt structure looks like, what are the different pieces of debt, and also what are the different operating leases. And one of the feedback that we get from a lot of our credit folks is the models that they have seen outside, be it from the sell side or something that they have built by themselves, tend to lack the level of specificity that they require because of how deep they want to go in both the adjustments as well as the debt breakdown. So what I will try to do today is I will try to walk you guys through a couple of examples of companies that are high yield issuers, where we can look at these models and get an understanding of what data we collect at Daloopa, and therefore you can get access to. So without further ado, I will like to share my screen and walk you guys through.
I'll share my screen, all yours.
There we go. Okay. So on my screen right now, if you guys see it, Anas, do you see a model?
I see it, and I had just before. I just had a very quick question because you bring about a very good point about the level of depth and when it comes to data points. On average, I mean, how much do you think we have in terms of data points for our models?
Yeah, so on average, our models are somewhere between 1,000 to 2,000 data points per model, and what we tend to see is that's usually a lot more data points that our customers are used to seeing. I think most sell-side models have somewhere between 80 to 150 data points. The models might be longer than that, but the true data points are a lot lower. So the level of detail of a Daloopa model, what we've seen is it's somewhere between 7 to 11 times the level of detail of your regular sell-side or buy-side model, right? And when it comes to models for high yield issuers, we've seen a significant, an obvious significant difference between the level of detail of high yield issuers versus non-high yield issuers. With high yield issuers giving a lot more data. There are multiple reasons why that might be the case, but high yield issuers tend to give you a lot more data. So the first example I'm going to pull up here is Hertz. Anyone here who covers credit would know about the issues that Hertz have had in the past and the level of complexity of the debt stack for Hertz. For those of you who's not looked at Hertz before, one of the key primary problems with this business is they have a lot of debt outstanding, but they also have operating leases outstanding, And a lot of that is the operating leases as it pertains to the key asset, which in these cases are rental cars. Right. So we'll walk through that. Now, first, let's take a look at the operating drivers of the business. Right. So the thing about Hertz is they disclose a ton of operating details. Right. They give you fleet composition by manufacturer. They give you revenue utilization. They give you RAC. They give you, international revenues, FX adjustments. So they give you a ton of detail for you to be able to understand the business on a geographical breakdown, right, down to a very detailed level. They even give you like airport versus non-airport type breakdowns and so on. Then of course you get, all your segmental breakdowns. As with all the Daloopa models, you get asset breakdowns. You get also all the different breakdowns that the company provides, right? So just the breakdowns in the operating data alone will run you close to 1,000 rows of data, right? Geographical breakdowns.
Yeah, we can see that. You're still scrolling down.
Yeah, and then you get to the income statement. So all equity credit guys like the income statement laid out. But where we see a lot of difference is as it pertains to the balance sheet and the cash flow statement. So what is unique about the Daloopa balance sheet is Daloopa's philosophy with data collection is we collect data as is. Whatever the company says, we collect, right? We'll always get it right. What you won't see us do is you won't see us say, hey, I know total, accounts payable. Let me just collect that. Let's ignore vehicle versus non-vehicle. You will never see that, right? Whatever the company disclose, we're going to capture. We're not going to aggregate data because we believe that it should be aggregated a certain way. We're only going to display data to you the way the company has disclosed data to the public.
So we're basically providing data without the assumption that this is the right data that they want, because it's different use cases for everyone, correct?
Exactly. Yeah, that's exactly right. Right. We don't provide our opinions or assumptions into the model. You are the analyst at the end of the day. That's what you're good at. That's not what we're good at. We're very good at getting the data right.
And this is what we keep hearing from clients. I mean, on a very frequent basis, this is what we keep hearing from them. It's just, you provide me what I actually need, not what do you think I need.
Exactly. Yeah. Because at the end of the day, there's a fine line between collecting the data and using the data.
Yeah.
Right. And what you want us to do is you want us to collect the best data possible. You don't want, you can treat and analyze and aggregate and delete and add data as you see fit. Right. That's what you're trained to do. That's what you do on a daily basis. Right. But what you don't want to be doing is you don't want to be laying out every single adjustment. Right. Your job is not to scrub the 10Q and read it forward and backwards. Your job is to take the data and make judgment calls on what the data means. Let it be our job to scrub the 10Q for you.
Yeah.
So the other thing about our data that people like is, let's say there is a particular adjustment that you care about, right? Let's say you really care about operating lease liabilities. If you look at Hertz from a credit perspective, you are going to care about operating lease liabilities. You can always click into that number and we will pull up the actual source. Different screen here. We'll pull up the actual source right here, where the data is from. This is important for two reasons. The first is we want to guarantee that all of our data is accurate and provide you with the means to actually audit our data. Every single Daloopa data point is auditable. The second thing that credit people like a lot is once you get here, you are in the 8K. Or the 10Q or whatever document the data is from. You can now scroll around, you can read and appreciate what is going on. The second feature that a lot of credit investors really, really like is what we call the stitcher. So where the stitcher gets very powerful is when it comes to information, like for instance, revenue earning vehicles net on an international scale, right? Let's say you want to see the source. This is a 10K source. Right, across all of these numbers. Historically, what you have to do is you have to open every single one of these 10Ks, find each of these numbers, and then verify that these numbers are right, read around to understand the context. With Daloopa, all you do is you literally click on this international. And what we're going to do is we're going to stitch together the piece of information that is relevant across all the 10Ks into 21 10K, 20 10K, 19 10K. So we're going to stitch all of that together. And if you want to dig in and see more, you can just click in to the link. We'll bring you to the 10K. We'll bring you to the exact position in the 10K where it's disclosed, so you can read around, go through the adjustments and what have you.
Yeah, and
Right.
this is great. It gives you a lot of context, so you can compare how it was the year before and the years prior.
Exactly, yeah. So you can see all the information that you need to see, right here in one screen, right? The idea is you don't want to have 8 different tabs open, or if this was a quarterly number, you don't want to have 40 tabs open. You just want to have one tab open. You'll only care about this section, right? The 10Q is a very long document. The way you read the 10Q is never cover to cover. You read a piece of it, you read the piece of it for multiple different 10Qs, and then you move on to the next piece, right? The 10Q is not a novel, right? You're not reading from the first letter to the last letter. Nobody ever does that. So the stitcher function is something that a lot of people like. And when you come down to the debt breakdown, that's where it gets really powerful, right? But before we go to the debt breakdown, let's take a look at the cash flow statement. What you will notice about Daloopa's cash flow statement immediately off the bat is how detailed it is. It's very rare that you see cash flow statements that are fully flushed out because of the sheer volume of adjustments in it. What makes Daloopa's cash flow statement unique is the fact that we capture every single adjustment that has ever been disclosed in the cash flow statement. So if you look from cash flow from financing, you are actually going to get every single item. You're going to get proceeds from revolving lines of credit. You're going to get payments to the revolver. You're going to get early redemptions, right? You're going to get, your NCIs. You're going to get your share repurchase. You're going to get distributions. You're going to get everything. And again, every single thing is auditable. You can click into it. We'll give you the source. You can actually verify that the number is right. So this is the 10Q, the cash flow statement in its purest form possible. There's no data in here that has been aggregated. You will not see us aggregate data into other. If we say there's 4 million in other, that's actually because the company said there's 4 million in other, right? So that's what makes Daloopa's cash flow statement so unique and so pure in its form. The other thing that a credit investor will really care about is the debt breakdown. And Hertz is the best company to showcase the debt breakdown, right? We give you all the adjusted EBITDA breakdown here, right? Once you get past the financials, what you'll see is every single adjustment that gets you to adjusted EBITDA as the company discloses it. You will see debt adjustments. If they report debt on the balance sheet, you will see how the debt on the balance sheet gets there, right? The sum of the debt on the balance sheet. You will see all the adjustments to get to net debt. You will see all the debt as it pertains to vehicles, right? So like any senior note, any term loan on the non-vehicle stuff. You see the breakdown of term loans versus senior notes versus the vehicle financing stuff, right? In this section. This was the post-bankruptcy Hertz restructuring, right? All the notes post-bankruptcy. You see the reorg emergence charges that were being paid. And then if you come down to additional data, this is where you get the full flavor of your intangible assets. You get a full flavor of all the various debt breakdown that's relevant to the business. So this is where it gets pretty gnarly, right? And as a credit investor, this is the kind of information that you're looking for. You care about the term loans, right? We'll give you all the term loan detail. You will be able to see, and this is something that people love, you can see the history of how the company's debt stack has changed, right? Obviously, the two BC term loans are new, right? But you can also see that, hey, they had this floating term loan, senior term loan back in the day, right? They have a revolving credit facility back in the day. They have fixed term loans back in the day. Now it's converted into 26 and 29 bonds, right? Now it's converted into non-vehicle debt. So you can see the progression of the company's non-vehicle debt. You can see the progression of the company's non-vehicle debt subject to compromise. And then you can see the progression of the company's vehicle debt, right? All the different series of debts that's been issued. Obviously, now we're in the post-2022 vehicle debt series, right? So now you can see all of that. You can see vehicle debt other. So the equity people generally don't really think about this that way, right? Because at the end of the day, all the debt rolls out to be a single line item in your income statement. But when you're a credit investor and you get to pick and choose which credit you would like to purchase, that you want to know what all the other pieces of credit are, what the total breakdown of all the credit is. And to the best of my knowledge, Daloopa is the only company with the full-blown breakout of all of the credit, right? So Hertz is a fairly good example of how detailed it is. I'll very quickly touch on the second example, which is T-Mobile. So
I just want Thomas, if you don't mind, I just just want to touch on something because there's something that I noticed in the Hertz sheet. I think earlier you mentioned 1,000 data points. I think we were pretty close to 2,000.
Yeah, we are running hands at night.
So yeah, it gets even more detailed, I guess.
Yeah, so Hertz probably has close to 1,000 data points just on the debt related information because of how much debt the company has. And for a lot of our high yield companies, you're going to see something very similar, which is there's going to be a huge breakdown of debt and debt related information. So T-Mobile is a good example, right? In T-Mobile, they have debt like instruments that exist in the form of leases, right? So we have all the different lease breakdowns. We have all the equipment revenue breakdowns. You have obviously an income statement, your balance sheet, and your cash flow statement, right? Again, very detailed cash flow statement breakdowns. It's the perfect pure cash flow statement. And what you're also going to see, in this case, T-Mobile is unique because we collect both the cash flow statement from the 8K and the 10Q. The reason we do that is sometimes companies will have discrepancies in the cash flow statement because of either level of detail or on reported date. So we actually will have both the cash flow statements collected if we notice that there are significant discrepancies. And then we'll have, your adjusted EBITDA bridge before we give you all the debt, right? Just like you saw in Hertz, this is going to be the same idea. In T-Mobile's case, they have Spectrum license, right, which is unique to their business model. It's a huge asset on the books. So that's something that you're going to see broken down. You're going to see obviously the net debt broken down, right? The debt either to affiliates or lease liabilities or actual just straight up financial debt. You see the debt breakdown by type of note. This is something that's only disclosed in the 10K, so you're only going to see it in Q4 numbers. But let's say, right, let's use the Stitcher function again. Let's say, hey, I really want to dive into this 25.7.625, and I want to see where it was being disclosed. You can use the Stitcher function by just simply clicking on the note itself. We'll show you the debt table where the note was disclosed, and you can see, okay, looks like this note was in existence for 2 straight years. Again, you can click into the actual 10K to dig into it if you want to dig more into this note. Right, once you're in the 10K, you can control F around to find whatever information you want. But what you can be sure of is this sheet is going to give you all the T-Mobile, in this case, the unsecureds. And the best part is we're going to sum it all up so you know that the number is correct. You know that we're not missing anything because you can click into the 74193 and we're going to give you the 74193. It's going to match. So hey, we didn't miss anything up here. We caught them all because the Excel sum is getting you to the same number as what the company is disclosing. Oh, and by the way, every single one of these numbers are a hard-coded number that we are proving to you with an audit function that we collected. So you can be very sure that we're not playing games here. There is no, grouped up number. There is no other. Every single number is sourced. Every single number is correct. Our sum matches what the company is giving you because we actually collected every single number and our data is well scrubbed. So I know I went on for a little bit longer than usual. Anas, let's open it up for some questions.
Honestly, I think you really laid it out in terms of how it works. Let me see if we have any questions here. I don't believe we've gotten any. I think I think you explained a lot of the things. Let me check. Is there? I think we got 3 here. Let me see. The first one is, does Daloopa have plans on doing private issuers?
Yeah, so that's something a lot of our customers actually ask us. The unfortunate answer is no, we do not have plans on doing private issuers. What we understand from a lot of our customers is there will be companies that will issue debt where you will be able to get access to the debt. Let's say it's 144A debt. You'll be able to get access to it if you get access into the data room. And a lot of hedge funds, a lot of credit hedge funds will be in the data room. And the idea being, hey, if we cover public companies, why can't we cover these companies so long as the funds prove to us that they have the information? So that's something that we are interested in considering for sure. But right now we don't have the ability to do that because the relationships between us and the bankers are not set up such that we can have access to those data rooms and provide coverage of those companies for you.
Is that something that you're working on, or?
So the way for us to get access to that is a lot of our customers today are, some of the largest credit investors in the world, and we would like to partner with them.
Hence my question. That is exactly hence my question.
Right. So in order for us to be able to do that, what we'll need to do is we'll need our major credit investor customers to come together and say, hey, the 3 of us, the 4 of us, 5 of us, whatever, we're going to agree that we will let you have access to the documents so that you can provide us with the models. And, it will be a small group of us, and we will be able to share, we'll be able to pool resources together such that your work done once can be used by all 5 of us, right? That's something that we are interested in having that conversation with our customers, because at the end of the day, the issuer will never give us access because it does not benefit them. Our customers have to be the ones helping us push our way into those data rooms. And then, of course, once we're in the data rooms, then we'll figure out a way to take the data, extract it just like how we do it today, and then provide specialized access to our customers.
And to me, that actually, that is, I'm glad someone asked that question, where you bring that up, because I think that really speaks volume in terms of the relationship that you have with your clients. If you feel very confident that they are willing to partner up with you and open the doors for you, I mean, that really speaks volume in terms of the value they're seeing and the relationship that you have with them. Is that did I understand you correctly?
Yeah. I mean, that's our objective is just to solve our customers' problems, and this is a very clear customer problem. We have the technology to solve the problem. The sort of road bump here is not the technology or willingness, but the legality and the relationship aspect of the agreement. Because in a private debt issuance today, it's basically a 3-party game where there is the issuer, the company, there is the bank in the middle, there are the hedge funds, and we are bringing a 4th party, which is the data extractor, into that relationship. So it's a complicated relationship, especially since the data is not a one-to-one with a hedge fund. So we're not a private consultant to a particular hedge fund. In that case, that would be easy, right? But we are a one-to-many hedge funds. And so we will have to be able to prove to both the bank and the issuer that, look, if I'm going to service these 3 hedge funds, we are confident that we know that they are entitled to access the data room and nobody else is going to get access to the data. So there's a lot of safeguards that needs to be put in place. And the main hurdle is it's not technology or willingness, but the legality and the relationship and all of that takes time.
Yeah. And I know we're almost at time, but I do. We have received 2 additional questions. I think we have a couple of minutes. The first one is, this is coming from one of our clients. Are there ways to leverage Daloopa for screening of credits?
Yes, there are. So it's not so a lot of credit screening happens today by looking at sort of yield to worst, by looking at maturity, term, and so on. That's not something that Daloopa directly provides. But then again, you probably have a Bloomberg account. You probably can get that information in a matter of seconds. The way people use Daloopa to screen credits is actually from a more operating perspective. So one example is, let's say you are like a telecom investor, right? You are looking at all the satellites, you're looking at all the US, European telco operators. What you probably want to do is you want to build a com sheet with Daloopa's data that tracks, let's say, subscriber count across all the telco operators and gross margins or EBITDA margins across all the telco operators. And the reason is, at any point, if you see one of the telcos move away from median or move away from what historically they have been able to perform at, then you you basically want to dig in and see if there has been any dislocation. Because a lot of times people notice that, hey, the equity guys react very quickly to small changes in operating data, and the credit guys tend to take a little bit longer to get to that level of detail, because the equity guys, that's all they do. They cover these 10 companies over and over again. They know all the tiny details, whereas the credit guys are looking at a much bigger landscape. Right. So by the time the company's information gets to the level of significance for you to take notice, the equity guys would have gotten there first with their comp sheets, and the credit guys will be a little slower.
Yeah.
The way to bridge that gap for credit investors is to build the same comp sheets. Historically, that has been really difficult because you cover 100, 200, 300 companies. You cannot maintain comp sheets for just the sheer volume of companies you cover, unlike the equity guys. But today with Daloopa's data, you can, because all of our data is updatable at the click of a button, right? Yes. Previous webinars, we talked about this. You click a button, all of your comp sheets instantly updates. And so if you are a telco, if you are, let's say, a TMT coverage credit investor, you can have all of the global telcos on one sheet. You can have all media companies on one sheet. You can have all, hard tech on one sheet. You can all software on one sheet, so that at a click of a button, you can have a massive TMT comp sheet updated for you to see what companies are falling out of, trend.
Yeah, and I would encourage anyone, actually, we do have a very good video where we covered this very topic, actually, that's available on our LinkedIn and YouTube channel. So make sure you look for that. The last question, Thomas, is we look a lot of stressed names where the market cap tends to be small. What is coverage like for these names, and can we request them to be built if there's no coverage?
Yeah. So the general policy at Daloopa is we cover companies above a $2 billion market cap. But obviously, when a company gets stressed, market cap, which is the equity value, tends to collapse, even though the enterprise value still sort of remains where it is. In those cases, Daloopa will elect to cover those companies. That being said, because of our back-end screening methodology that we use market cap as the primary screener, there is a good chance that we might miss out on some of these names. We try not to. We try to be thoughtful. We try to use EV. We try to think about what actually is going on. But once in a while, a company or two will fall out of favor. Yeah. If a company is of interest to you to cover, especially since the name is topical, the market cap is small, but the EV is actually a lot larger, we would love to cover those companies, right? Those are the companies we would want to track. Even if they're heading into bankruptcy. So you will see that some of our most detailed models today are companies like Hertz that for a period of time had basically next to no market cap, or companies like Frontier, which obviously went through bankruptcy and for a period of time had basically no market cap. So these are companies that we love to cover because we have a lot of credit customers. And if you are looking at that credit, there's a very, very good chance that your peers are looking at it too, and a lot of your peers might be our customers too. So we'll like to cover those companies. Just let us know and we'll take care.
Yeah, and that really speaks volume in terms of the relationship that you have with your clients. But I know we're at time. But Thomas, really wanted to thank you for this, and I want to thank everyone for joining today. Again, a recording of this in previous webinars, so especially the one with regards to the plugin where you can update your sheets, as well as the KPI builder, are available on our YouTube channel. So thank you again, Thomas, and we'll see you in the next webinar.
Thank you. See ya.